All right, welcome back to another video. And in this video, we are going to be talking about some very interesting subjects. And that's this idea that the currency reset has already begun, actually. And we're going to be discussing how this manifests, shows up in our life, especially as it pertains to our everyday interactions with our savings and with inflation. So we're going to be talking to my new online friend, Vince here, and we're going to be discussing in depth how this shows up in our market, how this shows up in our everyday life. Hit the like button on this side or this side to send this video out to more people. Give us a comment down below and let us know if you enjoy this video, and a shout out to our channel sponsor, which is Vizsla Silver. So thank you, Vizsla Silver. And if you're looking for a mining stock, be sure to check out Vizsla Silver. And it's good to see you, Vince.
You too. Thanks for having me. Been looking forward to this for a while.
So you said something that I thought was pretty interesting, because the currency reset and kind of what the future of the monetary system is a subject I'm interested in, and a lot of our content is published in that type of subject. And you said it's already begun. It's already started. It's already happening. What do you mean by that?
Well, let me just start by saying a lot of people don't want to, and you and I discussed this off camera. A lot of people are scared to talk about these things because it comes across as conspiracy. It's not. It's reality. I mean, how many so-called conspiracies became truth in the last 10 years? So this is not a paranoid statement. We're talking about how governments operate. And when you ask the question, how is it happening already? Well, if you owe a lot of money to someone and you control the ability to print money, then you're going to print more money to pay that debt off. So currency debasement is, and this is what it is. Currency debasement is a slow default, a slow, orderly default on debt. So I have debt, right? You and I are in business together. We do a trade, okay? And we're going to trade in chickens. And I borrow 5 chickens from you, and I owe you 5 chickens. And you say, Vince, pay me back in 5 years. And I go, okay, that's what I'll do. But over those 5 years, those chickens lay eggs that I have. And I now have 100 chickens. And so when I give you the 5 chickens back, it's nothing to me. I still have plenty. I've devalued the amount of a chicken. 5 chickens used to be worth a cow. Now 5 chickens is worth, a small cow. I don't know, maybe a half a cow. The point is, as there are 2 ways to default on debt. One is to say, I'm not paying. I can't pay. And the other is to say, I'll print more to pay. So the weaker your currency is, the higher your interest rates. But the weaker your currency is, the easier it is to pay off debt. So we are currently debasing our debt slowly. And what's the expression? Slowly and then all at once. Well, the reason that we're not noticing as much in the U.S. is because we have the world reserve currency, and so there is an imbalance. The world has to have dollars on their balance sheet so they can purchase things. Everything is done in dollars, and so that gives us a license to print, because we can create demand for the dollar because the dollar supports the economy. As the world comes off of the dollar standard, you're going to see what a banana republic looks like. And that's probably going to be our monetary system.
So if they dollarize the whole world, it was just, I believe it was yesterday, the quote unquote government is quote unquote giving the IMF, I think 650 billion or something like that.
Right.
And I say give it because, it's really coming from the printed into existence from the Federal Reserve through the conduit of the US government. But that's an example of them. And then they're going to go loan this out for quote unquote COVID relief to all these countries. So that's an example of dollarizing, right? So people will say, well, because it's the reserve currency and they have dollarized the world, you're never going to get significant inflation. You're never going to have people go off the dollar standard. It's always going to be the reserve currency. So what's your thoughts on that?
Well, you're talking about the IMF and SDRs, and you're actually being kind. It's way worse than that. So we'll talk of that in a second. But I think the mechanics of how the world currency makes our dollar artificially stable kind of goes like this. I'm Australia, and I need to buy oil. And because oil is denominated in dollars, I need to have dollars as a reserve currency on my balance sheet. So banks of countries, central banks, countries keep money. I do some business with Russia, I do some, and they want to deal in their own currencies, but on the big global geopolitical assets, you're dealing in dollars. So they have to keep dollars in their bank. They have to be able to get dollars quickly. And if they don't have enough, they have to convert to dollars. Oh, we need to buy oil. They only take dollars. So you're constantly taking your own currency and transferring it to dollars. So it creates an innate demand for the dollar. So what happens is and that's happened, when we went off the gold standard in 71. That was part of the deal. There was a lot that went on there. It wasn't just going off the gold standard. It was a lot of things that were setting us up to debase the dollar, which is what we did then. What's going to happen now, and I'm not saying it's going to happen tomorrow, but it's going to happen slowly, as we discussed. As economies grow, and we'll just say China, for example, as the Chinese economy grows, when you are the buyer of goods, all right, this is important. The buyer of goods determines the price, and the buyer of goods determines the medium of exchange. And by that, I mean, you're selling something and I'm buying it. Now, granted, I'm going to pay your price. I determine the price. Demand determines the price because how much I want it. But you'll take whatever currency I give you, provided it's enough. I want to give you dollars. You're like, all right, I'll take dollars. Why? Well, Vince is going to pay me 5 more units more in dollars than he would in, Australian dollars. So what ends up happening is trade is dictated by the demand side. You could see this in exchanges. It's another whole conversation we can have, but I don't want to go too much down a rabbit hole. But just to backtrack, the dollar, people who buy stuff, which the United States did for 100 years, the net buyers of things, the net consumers of things, and industrial as well as consumer goods, they determine the currency that it trades in because that's what they're willing to part with. We have dollars. We're going to use our dollars to buy stuff. And we become the de facto standard. And then we actually became the standard after 71. So what happens is, as China, now fast forward, as China becomes the bigger consumer of goods and infrastructure, so as China's economy grows, assuming that it does, I'm not saying it's not going to have a problem, as China's economy grows, you're going to see they're going to have a growing domestic middle class. And right now, China buys finished goods elsewhere, or more importantly, it sells finished goods to the US. We're their biggest customer. They make something, we buy it. They make something, we buy it. And then what's going to happen is the middle class in China, as it grows, they're going to start wanting to spend money. And so China is going to make stuff, and someone's going to want to buy it here in China. And so they're going to be doing more and more business in yuan, and it'll be big enough that they can go out to Saudi Arabia, and they've already done this, and say, we want to buy oil from you. But you know what? We don't want to buy it in dollars. We want to buy it in yuan. And Saudi Arabia is going to say, no way, guys, until you become the biggest customer. And the customer's always right. And when enough of the economy shifts organically to non-dollar denominated business, you're going to see the dollar it'll keep its name as reserve currency, but it will be used much less, and it'll slowly fall off a cliff like everything else that it's competing with.
Very interesting. So earlier you said that when this happens, then one will really see what a banana republic looks like. And You've also stated that this currency reset is underway. Tell me what you mean by that you'll see what a banana republic looks like, and what is this currency reset really? What does it look like 5 years from now? What does it look like 7 years from now?
Well, I think, that's That's kind of important. All right, so the banana republic is a cliche that people use, but it's actually rooted in how Latin American countries were economically colonized by the U.S. and how we ran their countries, and then went indirectly, and then how their monetary policies undermined their own dominance. So I'm going to give you an example of that, of a banana republic of governance. But the first thing I want to say is I want to address your question about how the currency reset goes. A lot of people are talking about the path of the currency reset, and what's going to happen next, and there's certainly very possible, and I don't claim to know how it's going to happen, but I know what's going to happen. What's going to happen is the people who borrow the most money. How do I put this? People who borrow the most money, who are the most leveraged and are the most important for an economy, will not have to pay those debts back, or they will pay them back in a debased currency. There will be bag holders in the world. The bag holders are the people who end up holding the bag when music stops, or musical chairs. So an emerging market that has to do business with the United States, they have to deal in dollars. They will constantly be dealing in dollars, and they will suffer when the currencies converge to zero. That's basically what it is. It's a race to the bottom. Domestically, the currency reset is felt like it's felt in inflation, and they're not necessarily the same thing, but it is felt that way. So we know that the dollar cannot be the dominant currency forever. We just know that. It's a fact. And while we have the dominant position that we have, we're going to try and cement and protect and ring fence our industries that we think are going to keep our country afloat, whether it be military or industrial complex or service oriented. What you're going to start seeing domestically would be if Americans are too indebted to buy something. I don't care if interest rates are zero. If we're too indebted to buy something, we can't get the credit. Like you and I, we own homes, interest rates are zero, try and get a home equity loan against that. What they're doing is they're raising the standards to the point where you have to have 50% equity to take money out. You can't get a home equity loan. And so what that's doing is that's making us not be able to buy. So back on the point, if the United States stops buying cars, which is not the case this week, and China starts buying them, and China's making them, well, China's not going to sell them to us anymore. They're going to sell them to themselves. And if you need to buy a car or I need to buy a car, we're going to have to pay a big enough price to justify that Chinese company or that foreign company selling their car in the US or setting up shop in the US. The demand is not going to be here. At the same time, the US government has a lot of debt. So the US government needs to make that debt worth less. And so you do that by printing money while there's demand. I'm not sure if I'm answering your question directly, but the currency reset is going to go like this. Right now, all economies, let's say we'll say large economies, G7, G8, those economies are trying to inflate themselves out of a recession, meaning they're trying to create demand for their own goods, buy our stuff. And so they're exporting their deflation. They're saying, okay, here, you buy stuff, we want more money, we're going to use it for other things. And the consequence of that is if it's successful, you'll end up having too much money floating around and you won't have enough demand on this side. And on the East, you'll have a lot of demand. And it ends with a lot of people being saddled with debt. Half of them want to have a riot, and the other, well, half's not the right word. Right? 90% are going to want to riot, and 10% are going to want to build a wall around themselves. And the 10% are going to do what they can to protect themselves, the middle class and higher, and everyone else is going to have a problem. So the government, in order to preserve, and this is where the Banana Republic comes in order to preserve the status quo, which is all they really want to do, is they're going to change the rules to appease people. And you're seeing that with the stimulus checks. I'm not anti this stuff, but this is the precursor to universal basic income. Taxes increasing, that's the precursor to a Banana Republic. your comment about Banana Republic, let me give you a real example. And it actually ties to gold indirectly. But I think people can understand this very easily. I was doing business in Argentina between 2001 and 2006. And I had a friend there who was Argentinian, and he was living in the US, and excellent analyst, Diego Perfumo. And he worked at exchanges as well. And I went down there, and this is what I saw in the streets. And this is coming to us. It's not coming tomorrow, but this is going to come in some form. A well-dressed man went up to me. I mean, he was wearing a suit. He was impeccably dressed and carrying a suitcase. And he asked me for money in Buenos Aires. And I almost gave it to him. And I'm with Diego and his partner, Bernardo. And I'm like, why? The guy obviously needed just some money for a train, right? You've heard this before. But he was really well-dressed. He didn't look like he was panhandling. And he goes, no. That guy's been out of work for 6 months. And he tells his wife he's going to work. He gets dressed and goes out, and he begs the rest of the day. And I go, really? I go, yeah. And this is what they said. And they said, Vince, this is the beginning of our downswing. 6 months from now, that guy won't be wearing a suit anymore. Like, this is the beginning of our problem. And so I drilled down on more of this, and I got an example of wealth confiscation, how it works with inflation and debasement. In Argentina, and I think this is key. This is huge. In Argentina, they were pegging the peso to the dollar artificially. So they're saying the peso's worth $1, the peso's worth $1. It's not, but the peso's worth $1. And what ends up happening is the industries in Argentina, and one of the big ones is farming. They produce a lot of soybeans. If the peso's worth $1 and I'm a farmer, and you're telling me the peso's worth $1, and they're willing to pay me $5 out there, and you're not willing to pay me $5 for my soybeans here, I'm going to sell it out. So the Argentinian government then, this is going to happen here, then punish the farmers for exporting. You can't export your goods anymore. So that keeps supply domestic. So that keeps inflation on these goods in check. But the farmers don't make any money and they go out of business. But here's the killer. I said to my buddy, I go, so what happened? He goes, well, the peso got so weak compared to the dollar that they could no longer artificially prop it up. They were printing pesos at a rate of like 20 per dollar and telling you that each peso was worth $1. It just doesn't work that way. So what happened, I said? He goes, well, they automatically announced overnight, which you're not going to see that here. They announced overnight, we're going to debase the peso. It was 1 peso per dollar now, and I'm exaggerating, but I'm not exaggerating by much. And now it's going to be 4 pesos per dollar.
Got it.
So overnight, you would go to a store and say, how much is a cup of coffee? It's a peso. You're like, okay, fine, peso. Next day, it's how much is a cup of coffee? It's 4 pesos. All right, well, that's more money. But it wasn't a problem because they just printed it. Okay? It became a problem when they went to buy stuff overseas. Their credit was no longer good because overseas, the peso is now worth 25 cents. Domestically, it was still worth a peso. Here's what happened that kind of freaked me out. So Diego says to me, they debased the peso overnight. They announced it. It was just like during the Brady Bond started this too. They, what did they call it? Peg. The peso was pegged to the dollar. They unpegged it, and the peso immediately went to 4 pesos per dollar. And I said, oh, you owned your house. I go, that's good for you. Your house was a hedge for inflation. Your house now goes from being worth 100 pesos to being worth 400 pesos. It retains its value. It's just denominated in 400 pesos. You're okay. You're just going to take a home equity loan and you're going to do what you have to. He goes, I couldn't. I go, why? He goes, because the next month, and this is what you have to watch for, confiscation of wealth. The next month, after debasing the peso overnight, they announced a 40% capital gains tax on all houses sold. So like that, his house went from being worth 100 pesos, let's say, to 400 pesos. And then if he sold it, he would have lost 160 pesos. So it really only went up by 200 pesos. So the government prints more dollars, right? And then tells you can't spend it and then increases the taxes. That's exactly what MMT and its like are doing or going to do. You're going to print more money and then you're going to raise taxes. So they printed more money. They did it in fast real time. It's not going to happen that way in the U.S. In the West, the West is too smart, or the North America and Europe are too smart. They're going to slowly and methodically weaken the currency, and like frogs in a pot, we're just going to wake up and be boiled one day. And then when we say, well, at least I own a house, I'm protected. No, you're not. Try and sell it. They're probably going to raise taxes on that. Or you won't be able to sell it because the people you want to sell it to won't be able to buy it because they now need a 50% down payment and no one has the money. So it's going to destroy the economy at the same time it inflates it. That's inevitably a banana republic, lies and lies and lies, and then has to have a big adjustment. We are doing a slow motion banana republic. Does that make sense?
Makes perfect sense. And it was very powerfully said. And so that's why I guess my next question out of that comes to, well, if you say it's not going to happen in the US the same way in terms of speed and the implementation of it, then at what speed is it implemented and how long does this trajectory play itself out?
Oh, that's a hard question. That's a really hard question. I'll try and answer that specifically, but I think the general way to look at it is humans, we tend to look at things in a line. So it's like, let's say I think it's going to go from point A to point B. And point A is 0 and point B is 10% inflation. Let's say I think that. And so we're going to draw a line as humans. Behaviorally, we're going to say, okay, maybe there's a slope in it. Maybe it'll be flat and slope higher at the end, like the hyperinflation concept. Maybe it'll be linear. Maybe it'll be steep and then flat. And humans, we try and look for patterns. And the problem is it's going to happen in fits and starts. It won't happen overnight. It'll happen in certain industries. So using an export example, if China, okay, let's say that we all need to buy a tractor, a John Deere or a Caterpillar tractor. If we don't have the money, if most of us don't have the money to buy a new tractor, but one of us needs to buy a new tractor because we're redoing our farm, we still happen to be in business, well, the price of that tractor is going to go up. And in China is the reason why, because in China, they're spending a lot of money on farms and they're going to be spending more money on tractors. So Caterpillar is going to be sending all their tractors to China. So when I say fits and starts, you're going to wake up one day, you and I are going to wake up one day, and let's say we're not farmers. I'm not a farmer. The price of tractors is going to go up, and I'm going to say, so, but that's going to affect 5% of the population. And then the next day it'll be the price of cars is going to come and say, oh, okay, so I can deal with that. But when you start to see capital goods go up in fits and starts, it'll be this goes up, that goes up. And then every demand that pulls goods at a higher price from us, it's going to happen. So it's going to be like this. Fits and starts is like the line, the CPI number, which is not an accurate number, will go up gradually. But in the things you want to buy, the things you need to buy will go up exponentially. The things you don't need to buy will go down in price. How many TVs do you need? They talk about the TV is still the same price using a concept called hedonics. It's the same price for a TV as it was 20 years ago, but it's got so much more in it. You know what? I want a TV like 20 years ago. How much is that going to be? Should be less, right? Sorry, you can't get those. I mean, when's the last time you tried to buy a stick shift car? You can't. You have to get the upgrade now. So the concept of deflationary prices in goods, it's stuff that we don't need. The stuff we need is going up, whether it be toilet paper or food or silver eventually.
So you talked about wealth confiscation. You just mentioned the word silver. And then you look at the kind of right now, the macro environment where the 10-year has been rising, the dollar's been moving up. There is the camp that says the dollar is going to go up, and this whole inflationary scenario isn't going to play itself out. Give me your that was your macro bird's eye view. Now give me, where are we at right now in this real time? Gold and silver have went down, not up. The 10 years risen. There's a lot of insecurity in the overall broader market too. People don't know what to make of it. But where are we right now?
Yeah, that's kind of important. I mean, we may all agree on the ends, but how we get there is not necessarily where we agree. So I think it's important to look at those paths. So from a trader's point of view, if you're looking at so I'd like to answer that as a trader in the short term, and then as a trader in the macro. I think that might be helpful. In the short term, if you're looking at, say, something like, we'll stay with precious metals, right? If you're looking at precious metals, and they're not going to trade like consumed commodities do, but we're staying with precious metals in general. The price, if you're worried about inflation, you're looking at the markets from day to day and you're trying to make sense of what's going on, when the dollar goes down, gold goes up because it's denominated in dollars. When the dollar goes up, gold goes down. That's a true relationship. Well, recently, the dollar has come off its highs. Now it's starting to rally again, as you pointed out. The dollar is well off its highs, and gold really has been, sideways, lackluster, I guess is the term. Why is that? And that's because there's another factor affecting gold or precious metals, and that is the bond yields. As bond yields go negative, and we're not nominally negative yet, but we probably will be. But as real interest rates are negative, meaning interest rates are 1%, inflation is 2%, so your real interest rate is a negative 1%, that reduces the risk in owning gold. There's no opportunity cost, there's no interest rate cost. So people are going to put their money in gold because they're not getting interest anywhere else. But recently, as the dollar bottomed and started to turn, the bond market got annihilated. And gold has been moving with the bond market up and down, because as the bond market rallies, that's a decrease in interest rates. And as interest rates go down, the opportunity cost of owning gold disappears. And so people would put their money in gold because, hey, I'm not getting any interest on bonds. But as interest rates go up, as the yields rise and bonds drop, which actually is a sign in the long run of inflation being a problem, you have a situation day to day where, the dollar's down, why isn't gold up? And you have to look at the bond market. The bond market is down. With the dollar down, then gold will not go up. Now, the bond market is up with the dollar down, then gold will go up. So on a day-to-day basis, we all understand the dollar relationship, but I think the interest rate relationship is very important now, especially since we're flirting with negative interest rate policy, or NIRP. And that's the short term. That's how you make sense of the day-to-day without going crazy. The macro path, to your broader question. Okay, so people are looking at things most people are looking at things in a digital way, deflation or inflation. And I say, without copping out, I say both. And here's what I mean. I'll give you two scenarios that could happen. One scenario is, and I can get very granular on this, but I'll try and stay broad. One scenario is, for whatever reason, the Fed starts to raise rates. That's because of the fear of inflation. The Fed raises rates, which slows the velocity of money. Now, that controls inflation, but financial assets, stocks and bonds, are sitting on the skin of a bubble, and so they will come in a lot quicker. So the Fed raises rates. Here's a scenario. The Fed raises rates, stocks crash. Who knows why? It's like a butterfly flapping its wings on a volcano somewhere. Then, to handle that problem, because they were too aggressive, they're going to do something else, like a QE concept. They'll do NIRP, they'll do more MMT, and then you have inflation going into hyperinflation. That's one scenario. The Fed raises rates and gets a little too cautious, and then they have to reverse quickly, and then we have just uncontrolled inflation. They're just like, we don't care anymore. We're just going to keep printing money, because we can't figure out how to stop this deflation. Look at what happened in Japan. So the other scenario, the inverse of that is runaway inflation, meaning the Fed never tightens, and then eventually the bond market collapses, which ends in inflation. So they have to end in inflation. And the reason they have to end in inflation beyond my little scenario is the government is much, much more scared of deflation than they are of inflation. Whether that's merited or not, that's how they operate. They need the velocity of money to move. And they understand the Great Depression and what it did to people and how deflations cause wars quicker than inflations. At least with inflation, Democrats used to say in the 90s, well, at least with inflation, everybody was working. And that's kind of the thing. Everyone's not working right now. So we may have a higher price for our goods, but there's a lower income for people that are not working. And they're worried about that. And that's what I think is going to happen. I think we're going to have one of two paths. Either we're going to have the Fed get cautious, and then the reaction after they do that is going to be like the echo that causes the sort of hyperinflationary situation. Or the Fed will stick to what they're doing. And this is the worst case scenario, I think, for us, but I think what the Fed wants is a slow debasement and default. They want to create as much debt as they can and get someone else to own it, holding the cards before they pull the rug on the US dollar. And that would mean they let inflation creep in from 1% to 7%, but you never have an overnight adjustment. And they'll do that by cooking the books, CPI, PPI, whatever they have to do. But what ends up happening is the path leads to inflation, but it doesn't mean we can't have a big deflationary event before then. It always ends with monetary policy, always ends with printing too much. It doesn't end with printing too little. They want to print too much. That's the best way I can say it.
So when you're looking at right now, some people have said that we're going to have a market crash. Other people have said the Fed will maybe even step in soon and start to control this bond situation to keep the stock markets, heading higher. They passed their first 1.9 trillion stimulus, and they've discussed this 4 trillion infrastructure, and they say they have another quote unquote COVID relief coming. I think they said in like April or something like that, April and May. And so, the theme already seems to have begun that they're going to step into the latter one that you said, which is, as you evidence that maybe they're not going to be stepping in and raising rates. Maybe they're going to try to inflate this out. I don't know what the answer is, but just curious what your thought is on that.
Okay. You're definitely on top of what's going on. That's very true. The Fed's going to consider if interest rates get right now, the Fed is hoping that the bond market regulates itself. So if inflation becomes a fear, they don't mind if bond yields go up, because bond yields going up will slow down the inflation. Because bond yields go up, people take their money out of stocks and put it into bonds because the yield is higher. It's not about the yield itself. It's about how people perceive that. Oh, if bonds went from 1.7 to 1.8%, I'll take some money out of stocks and put into bonds, right? But the moment I start to believe that my confidence in the market to hedge itself is not going to work, bond yields went to 1.8%, I'll take my money out of stocks. But I'm not buying bonds. That's insane. I think it's going to get worse. So as people start extrapolating and losing faith in the Fed, it gets worse. So there is a magic number, and I don't know what it is, but at a certain yield, investors are going to say, that's too much. And if the bond market does not regulate itself, as you were implying, then you're going to see yield curve control, which sets us up for the major inflationary problem that we will have. And where they come in and they work on the yield curve, it's not really hard to understand. And if you want, I can talk about that for a second, but that's what's coming next. And I can tell you what comes after that and why, as if you're a free market person or a libertarian, small L or capital L, it makes no sense that they're just stopping self-clearing market forces. But yield curve control is going to come if the bond market gets too weak or yields go up too much. Should we go into that?
Yeah.
Okay. So the yield curve, just to be very clear about it, the yield curve is the difference between short-term rates and long-term rates. And there's a curve that goes in there. But let's just say we're looking at the money market rate and the 10-year bond. Let's just say a bank loans to us in our money market at, whatever it is, 20 basis points now. Let's just call it 0. So banks make more money, the steeper a yield curve is. So at 0 and 1%, I'm doing 1% mortgages and I'm giving people 0, I'm making 1%. That's not a lot of money. Banks like to loan money at a steeper rate. So I'm giving you 0 and I'm offering 5. I'm lending for 5. So they're making 5%. And they have risk, the duration risk, right? But they have risk. What happens is, if it gets too steep, then the United States' ability to borrow money at a low interest rate becomes gone. It's gone. And we have to borrow money from other countries at a higher interest rate to finance our deficit. So while the banks are making money at 0, let's say it goes from 0 to 1, 0 to 10, the banks are like, okay, we're cool with that. That's 10%. I'm getting less mortgages, but we're cool with that. The problem is at 10%, we're borrowing money as a country to make our economy go. We're borrowing money to buy stuff, and no one wants to lend us money because we look like we're on a path to Armageddon. So what the government does is they do yield curve control. They come in and they say, we're not just going to influence short-term rates. We're going to influence long-term rates. We're going to buy bonds to drive these yields down. They drive the yields down to give the impression to the world that there's no inflation. That's the outcome. And the banks don't make as much money, but domestically, we feel better. People aren't going to lend us money. What ends up happening is you get to this point, and then the government, and this is where they put the pedal on the metal. They go, oh, we've taken it from 0 to 10 to 0 to 5. Then we go, you know what? Let's go negative interest rates. And now we drop to -2. And now it's over. Then it's just like off to the races. You have to own something real at that point. That's a fact.
When might that happen? And if the government and the Fed want inflation, but they don't want people to know it's as bad as it seems, then it does seem like from that vantage point that issuing that infinite QE to control these yields seems like that is a tool they would then rationally say is a good idea to control the perception of inflation. When does this begin to occur?
I don't know. I don't know when it happens, but I know it's a tool that they haven't used yet. They've used every other tool. And, people are going to say, if you want to put a number on it, if the long-term bond gets to 2%, then you might see yield curve control. What you'll probably see before that in the headlines when you watch the Fed people talk is you'll probably start seeing them threaten to do it. Oh, we're never going to do yield curve control. And then yields go up. But if we have to, we will. Then yields go down. They go, oh, we will never use it. And then, if you guys are bad, we're going to do yield curve control. And so they try and use their tool by threatening it. They threaten to use it. Would they ever really have to actually do it? Yeah, I think they do. And I think the thing that forces their hand is and this is not something you're going to see day to day, but as the U.S. economy shrinks as a percentage of the global economy, or as China grows, you're going to see us need to manipulate interest rates lower on a much harder fashion. So 6 months, they'll start talking about it. Right now, they're saying we won't do it. 6 months, they'll start talking about it. A year, they'll probably do it. If you're looking for a number, 2% is a good number to think about. And ultimately, it becomes a nonstop tool. What was a one-time event becomes a tool in their toolkit. We'll only do lockdowns for this, and then lockdowns become a problem for everything. We only insist on taking away freedom for this, but then we do it all the time. It's kind of like Homeland Security and flight restrictions. What happens is, like in a banana republic, it's an emergency. We have to do it. So we devalue the peso. And then Argentina, they do it every time there's a problem now. It's an emergency. We're going to devalue the peso again. And it's Wednesday. We're devaluing the peso. It's Wednesday. And what happens is when you break the seal and you open up Pandora's box and it's done and the end of the world doesn't come, then people get more tolerant of it. And it happens more and more. And only people who really plugged into have their finger on the pulse of their own finances will start to say, hey, food's up 10% and interest rates are down. Well, why is that? Imagine this, Jake. We get all our oranges here, okay? We get all oranges. We get some from South America too, but we get all oranges in Florida and California. And this is Great Depression stuff. This is horrible. Americans will eat more oranges in a high inflationary environment because we can't afford kiwi fruits. Bananas are grown in South America and they cost too much to get here. So we'll start eating more oranges. You'll start seeing more advertising for oranges. Buy American, buy oranges. And then what happens is we have a drought. We have a frost in Florida. We have a problem. Then you see the problem manifest in real lives, which is exactly what happened in Texas with the freeze. We live in denial, and then Mother Nature says something and says, oh no, there's a reality here. And the reality is you have no oranges this year. Where are you going to get your vitamin C? All of a sudden we'll be talking about, getting vitamin C from cranberries or something like that. The point is the inflation will drastically affect our standard of living, which will affect our quality of life. Does that make sense?
Yes. So before I get into what are the ramifications of this and what does this look like when it gets to that point of for instance, negative rates coming in and we'll talk about that from a less high altitude in a moment. But when you basically summarize all that and you look at all that, then the next question is this a 50-year thing that happens in your and my lifetime? Or is this is coming, you said at the start, this has already begun. So is this a 10-year thing? Is this, when you say it's already begun,
right?
In what way, in what level of the journey are we on if it has begun?
I think, yeah, that's a really good and hard question, but I'll try and answer that. It's already started, and people at the periphery are feeling it. Whether, let's say, you're a person who's got a high level of debt, you can't get credit because of that. You're a waiter, you worked in a restaurant, you worked in the service industry, you're a small business owner that was affected by COVID. What happened in COVID, the COVID pandemic, was basically a fast forwarding of 10 years of economic activity in 1 year. But to answer your question directly, people are going to feel it at different rates, and those rates will be based on where you are financially in your career. Meaning, if you're younger, you will feel it more, but you'll be able to respond faster. If you're older, you will feel it more, but if you're well off, you'll be able to deal. If you're older and you're struggling, it's going to decimate you. So I think the answer to this question in terms of years is it's a generation. And by that I mean when the baby boomers have retired and are no longer responsible for the economic growth of the country, then you're probably going to see it get worse. And by that, I mean, between now and the next 20 years, you've got people that are going to be retiring with money and they're not going to be spending as much. So that'll keep the price of things down domestically. But as the millennials get older and they have made money, they're going to start paying up for things. So inflation is probably going to start at the younger generation, and it will affect everyone. But if you're older and you already have a nest egg, you'll survive. So I think the answer to your question in terms of years, as I'm thinking out loud on this, is 2025 to 2045 is an area, I think, of lower standard of living and or a two-tiered economy where the middle class disappears and you have affluent and poor. So you'll see people taking rockets to Mars and people suffering. It's not end of the world, but what I'm getting at is you'll see more of a tendency that you'll see a more split economy. You'll see haves and have-nots a lot more. And I think that's what's going to happen from the inflationary crisis. So I would say people like you and me, well, you're younger than me. So you may feel it and take it in stride over the next 5 years, right? You have a young child, right?
7 months, yeah.
Yeah, congratulations. So you will feel it 5 years from now when he's in school or she is in school. The 70-year-old, my aunt, she's 70, she just retired. She'll feel it because she'll only go to Florida 3 weeks out of the year, not 4. The people in the middle, like myself, and the people that are struggling that are retired or don't have enough money saved when they're retired, they're going to feel it right from the beginning, and that's going to be very painful for a lot of Americans not having an ability to get access to wealth that they have it, and not having it to begin with. So
yeah. So okay, so now the question is, and this is what really why I started the channel and what I'm most interested in, although there is a percentage of audience that would just rather only talk about the financial potential of investing and mining stocks in this type of environment. And,
right.
To me, all those things, the investment is a means to an end to pad myself a little bit more from what's happening. Mm-hmm. But everything I've looked at, whether it's the story of Zimbabwe, whether it's a story of Venezuela, whether it's a story of Argentina, when this happens, society it truly falls apart, and in major ways. And that's when crime goes through the roof. Obviously, yep. That's when, as you said, rioting goes through the roof. This is when massive social unrest happens, and so I wonder, in your opinion, what this looks like on a smaller level. I mean, this is so obvious to me. One of the more frustrating things is it's not that obvious, or maybe it's just very terrifying to a lot of people, so they don't want to discuss it and talk about it.
That's a good way to look at it. They don't want to think about it. Right.
Yeah, but it's so obvious to me. Right. And especially having a 7-month-old daughter. I mean, to the point that, I'm looking at second passports and really spending a lot of my free time researching and coming up with ways in my head this plays out and where might be better places to be, both in my residence and in my finances. And so I'm fascinated with what this looks like. And so I'm curious, what are the ramifications of all this on a social level? And what is your opinion to that little rant I just did?
I've been reading a book, and it's from 1971, and it speaks to, it's not the fourth turning, it's much more archaeological. It's called The Collapse of Complex Societies by, I think his name is Joseph Tainter. It's a very academic book, but the first chapter answers your question. What happens when a society has a crisis? And it has a list of like 12 things. I wish I had it handy. But the list says you'll see things become more segmented. You'll see complexity break down. You'll see things become more like fiefdoms, and it becomes harder to make broader comments like you'll stop buying stuff globally. You'll live locally. Does your area grow walnuts? Well, that's what you're going to eat. Does your area, is it a fishing village? That's what you're going to do. Now that's an exaggeration, but this guy studied tons of societies, and he said, at the end of every great society, even if it's just a cycle, and you think we're going to come out of it, you're going to have a breakdown of internationalism, which translates into a breakdown of your environment. So locally becomes hyper local. People don't go further from their homes. People will people that can afford it will protect themselves, whether it be economically or with other means. It manifests itself with politically all the things we're trying to do now, very inclusive. They end up falling by the wayside because you can't include everyone. It's the Roman Empire collapsed at the edge of its most, I guess, wokenness, in the sense that they were trying to be inclusive of everyone. And while they were trying to be better humans, whether they were doing it right or wrong, I don't care. While they were trying to be better humans, the external forces, barbarians in this case, came in and destroyed them. But in reality, they had destroyed themselves internally and had themselves made weaker. So to speak directly to that, what happens domestically? Cost of education remains high, but then the government comes in, and the government will do everything it can to prevent civil unrest from getting too bad. Here's an example. After World War II, we were worried about communism. And as communism rose in Eastern Europe and Russia, the US, which had been politically conservative and capitalistic, started to have unrest, civil unrest. And you had the rise of unions. You had the rise of fair practices and civil rights. And they were due, that we needed to have them happen. But the government had to let them happen because the alternative was communism. If we didn't give people more rights, it would have been worse. And so the government actually was like, think about it. Richard Nixon was pretty liberal. He didn't hurt the unions. He was very progressive in these things. And what ended up happening was the alternative was either you let the unions have power, you liberalize your civil rights, or the alternative is communism. And that's what happened. And now that communism has collapsed, now you see us going back towards a more conservative, at least, attempt. Conservative, unions are less powerful. There's no communism. Unions are less powerful. Civil rights are an issue again. So fast forward to what's going on here. You want to know what's going on here? Look at Europe. Europe is Rome. And the dislocation of people in the Middle East because of drought, because of war, because of bombings, because of all kinds of reasons, is forcing massive immigration there, and they can't digest it. They're trying to liberalize their society, but their infrastructure can't hold it. It's going to collapse. And what happens here is, and this is where I trust our government. Our government's watching that, and we're going to do what we have to be the one-eyed person in the land of the blind. We are in an incumbent situation. We're going to see the mistakes that Europe makes. We're going to see that the mistakes countries make with cryptocurrency, and we're going to have the luxury of fine-tuning here. So you may see the rise so it won't be unions this time. It'll be UBI. It'll be college education paid for, and standard of living will drop for everyone here, but it will still be well above what everyone in the rest of the world is. And I think 20 years from now, we come out of this in a much better place. But I mean, to answer your question, I think the one thing I do trust about our government is is while they may be disingenuous in what they're really doing in the whole slow currency debasement, I got news for you. We're not going to suffer the most. Other countries will.
So then the question, I guess, too, and first of all, this has been a really interesting, really fascinating. I've really enjoyed this conversation. I enjoy talking about this even a lot more than the granular investing stuff. This is very fascinating. So for you as a listener, if you have enjoyed this conversation, please make sure that you hit the like button right now as we keep moving on, just to send this out to more people. Give us a comment down below if you'd love to see Vince back on. One area that would be fun would be to go in. You said that you had those 12 points that were discussed. Maybe from society, maybe that would be an interesting future conversation to go into.
I can leave it in, I can leave it in the comments if you like.
Yeah, but it'd be a fun thing to hear you talk more about too. You're an interesting guy. So we'll go there next time. Let us know in the comments if you would like to see that. So then let's wrap up just with assets and investments, which, as a final question, what happens to gold? What happens to silver? What happens to crypto? Do these things eventually just skyrocket? Does gold and silver stay kind of where it's at until one day you move into the real negative rate environment?
Right.
What's your conclusion here?
I think broadly it's between financial assets and real assets. So we're talking about precious metals, we'll talk about houses, real estate, and talk about other real assets versus stocks and bonds. I think here's a scenario that might scare people. The stock market isn't in a bubble, Jake. The stock market is where it should be. It's reflecting a very high inflation we're going to have 5 years from now, because stock markets outperform before hyperinflation. The market, so it's trading at 30 PE. That's crazy. That's high. I'm using fundamental analysis. The market's not pricing fundamentals. The market's pricing too much money chasing too few goods. That's what's going on. But it's not filtering down into our stuff. So you may never see a crash that remains a crash. Yeah. You may see something like Japan had in the 80s. They made a high and they flatlined for 20 years. Now, if we make a high and flatline, that's deflationary. If we make a high and go up and then crash, that's inflationary. The market will, you get a higher price in stocks because the currency it's not denominated in is going down. It takes more dollars to buy something. It's inflation at the financial level. So what happens to real assets? Some of this is not necessarily going to be popular with people, but I'm telling you, I have skin in the game in this way, and I think people that are honest with themselves will nod their heads. If you think your house is going to be a hedge against inflation, you're wrong. It's not. If you think your house is a piggy bank that's going to bail you out, you're wrong. It's not. You're not going to be able to get money out of your house. If we have inflation and rates go to 10%, but inflation's at 15%, no one's going to lend you money. You're not going to be able to take that money out to buy the loaf of bread you want. If interest rates stay at zero forever and we have what's called like a zombie economy, your house will continue to go up in value. But no one's going to lend you money because they want to make sure you have 20, 30, 40, 80% equity in your house. It's going to be hard. Try and take a home equity loan now. Oh, interest rates are at zero. Try and take a home equity loan now. It's very hard to do. Your house is your home, and it is a place of safety. Assume that you're not going to move for 20 years. Assume you're not taking money out of that for 20 years. Assume that you're living there. Real assets that will appreciate are, and I say it in this order because I started trading silver in 1994, silver and gold. And I'm not I'm not a gold bug. I'm not a metals bug. I'm a person who understands the dynamics of the market. Frankly, the thing that I would buy first as an investment and expect to make money off of it, not preserve my wealth, but expect to make money off it, is copper. And that's another conversation, but it has to do with electronic vehicles. And it sounds obvious, but it's not. Second thing I would buy is silver and not expect it to go up for years, even though it's probably going to go up before then. And the third thing I'd buy is gold. Now, this might be a little controversial. Gold is money and silver is not. I'm not saying silver doesn't have monetary qualities, but central banks hoard gold. They don't hoard silver.
Right.
That's going to be a positive for silver. Because central banks hoard gold, they will never let it rise to its true price. It won't happen. They can't do that because then that competes with their own money. They will continue to buy it. The IMF will release SDRs. And by the way, SDRs are baskets of IOUs of currencies. They're not even fiat currency. They're IOUs of fiat. They won't put gold in an SDR, I don't think. I would be very surprised if they did that because that would legitimize it. So while they're buying gold, they're not going to let it go up. Are they going to confiscate gold? No, you're going to be able to own your gold. Maybe there'll be a 40% tax, like my friend in Argentina. Maybe they'll start to maybe they'll be QSIT. Your gold will be accounted for. Maybe you can only buy gold on a blockchain. Maybe everything that you do is going to come out of an electronic wallet and they'll know where your money's going. Like everyone's your accountant now. When gold skyrockets, now it sounds like I'm contradicting myself, but gold has a chance of skyrocketing. It'll be, as you implied, that's why I laughed, it'll be too late. If you look at what happened in the 70s and 80s, inflation-wise, gold was the last thing to spike, not the first. So this appreciation we've had in gold over the last 10 years, well, actually 10 years has been flat, right? This appreciation we've had over the last 25 years, that's been slow debasement. That's been the market going up. That's been more debt. But the truly inflationary move hasn't come yet. It'll come after bread is $5, milk is $10. It'll come after that because the joke used to be you can't eat gold. So gold will go up. Gold will go up in value, but it's not going to have this meteoric rally because as people are struggling, yeah, maybe people with money are going to put some money in gold, but you're not going to have retail going in and buying gold because you're not going to the store and buying a ham and cheese sandwich with gold. You're not. You're just not doing that. They're not going to let you do that. So why silver? But what I'm getting at is own gold. Be surprised when it goes up. You want your gold to go down because that means everything's going fine. It's insurance. It's house insurance. I have fire insurance on my house. God forbid if I ever need it. God forbid if you ever need your gold to go in to buy a sandwich at the deli. You got some big problems. You're probably going to be buying guns with your gold, not ham and cheese sandwiches. Why silver then? If wealth for precious metals and other real assets like real estate is confiscated. So for example, I'll give you 3 assets that are real that could appreciate in an inflationary environment that will also have a risk of wealth confiscation. Houses, they will confiscate your wealth by not letting you get out of it. You can't take a home mortgage. You can't take a home equity loan. You can't resell it. You can't borrow against it. Or when you sell it, they'll have a big tax on it. That could happen. Gold. I said why gold. Gold's not going to do what it could until the very end when the wheels have come off the car and the government can't keep anything in control. Oil. Let's say you have oil stocks. Well, oil stocks will do well. But oil itself, you might have big taxes on capital gains, which they're talking about right now, right, Jake?
Mm-hmm.
They're going to be raising capital gains taxes. They're going to tax people. So why silver? Because yes, they could put a silver on all futures transactions. They could put a tax on silver in physical. But silver's got 2 things going for it. One, if they prohibit the ownership of gold, they won't. But if they did, silver will track gold at a much lower ratio. It'll go from 68, 70 to 1 to down to like 20 to 1. That's number one. Number 2, silver will continue to increase in industrial use. Electronic vehicles, it will start to perform more like copper. So it's a green metal, although it's not talked about that way. And the third thing is silver it's a currency. Now, it may not be money, but it's currency, meaning it's more portable for transactions. I'm not saying you're going to walk in with an ounce of silver, but coins were made of silver. And I'm not saying that's going to happen again. It won't. But silver, you can buy in smaller chunks. Silver is like a crypto in the sense that you don't have to buy a full contract. You can buy a piece of it. The answer about crypto assets, I don't look at those as a hedge against inflation, only because I look at them as a speculative hedge against debasement. We used to say 5% of your money should be in precious metals. Maybe that number is 10%. Maybe that number is 20% of your wealth should be in real assets if you're over the age of 60. That's what I think. And then 40% should be in income, and then the rest should be in speculative. Well, of your 20% in real assets, let's say that's a number that you agree with. I think, 5% of that, 10% of that, which comes out to be 10% of 20%, 2% should be in cryptos. It should be in something that gives you upside, like owning Apple in the 80s, like owning Amgen or Johnson & Johnson before they came up with a miracle cure for something. For an older investor, cryptos should be a speculative asset in your real portfolio. For a younger investor, maybe you want to put more into it. But you're going to need real assets that you can make into money to weather the storm that is probably coming. Meaning you can't convert your house into money tomorrow. You know what I mean? It's hard to do.
Absolutely fascinating conversation, Vince. It was fantastic to have you on. For everyone listening, please leave a comment down below. Let us know if you've enjoyed it. Let us know if you want to see Vince back on. Let us know if there's any specific subjects, questions you'd like to see when we come on next time to discuss. Give us a comment down below. Make sure you hit the like button on this side or this side right over there to send this video out to more people. Make sure you also hit that bell notification and subscribe to get notified for new videos. Vince, that was absolutely fantastic. That was a very fun conversation.
Thank you. I've been watching your stuff for a while, and I appreciate you having me on. I like speaking with you, and you give people a lot of room to talk, and I think that's really good. I think your listeners should appreciate that, how you let things breathe, and I'm a fan. So I'm happy to come back. We can talk about whatever you want. We can talk about the end of the world. We can talk about the not end of the world. We can talk about all kinds of. We can talk about whatever you want to talk about.
Yeah, we'll put silver on the list too for a specific silver topic. I know that's one of your areas of expertise. We'll have a lot of interesting things to discuss. So we will see you next time, Vince.
Yes, thank you.